Everyone is asking the same question right now. Is the U.S. housing market about to crash? Prices are slowing, sales are weak, and people remember what happened in 2008. But the truth? It's not as simple as the headlines make it sound. Because behind the numbers, there were hidden risks no one is talking about. Risks that could quietly destroy local housing markets while most people never see it coming. National trends. Let's start with what we do know. National home prices have slowed dramatically since their pandemic highs. Some cities are already seeing prices drop. Inventory, the number of homes on the market, is climbing month after month. And mortgage rates? Still much higher than they were just a few years ago, making homes less affordable for millions of Americans. So why is this happening? Three main reasons explain most of it. First, mortgage rates shot up after the Federal Reserve raised interest rates. Buyers simply couldn't afford the same homes they could 2 years ago. Second, inventory is coming back. Sellers who stayed on the sidelines are finally listing their homes. And third, the slowdown isn't the same everywhere. Tech-heavy cities, high-cost coastal areas, and places with big job losses are seeing much more stress than the rest of the country. This is why the national average hides so much. What experts don't tell you. Here's where things get interesting. There are risks building right now that most experts barely talk about. Number one, local meltdowns can happen even when the national market looks fine. One city could see prices crash 20% while the national numbers barely move. Number two, big investors own thousands of homes across the country. If they suddenly sell or stop buying, prices in some neighborhoods could collapse overnight. Number three, adjustable rate mortgages are resetting soon. That means thousands of families will see their payments jump higher, and some may not be able to afford them. Number four, rising insurance costs and climate risks. Some areas are becoming so expensive to insure that buyers are walking away entirely. And number five, developer debt. If small builders go bankrupt or projects fail, you could see waves of distressed properties hitting the market all at once. Real numbers, real warnings. Let's talk numbers. Home price growth is flat or negative in many metro areas already. Mortgage rates are still roughly double what they were in 2021. Inventory is up by double digits in some parts of the country. In home sales, weak nationally, but some cities are getting hit a lot harder than others. Put together, this isn't a national collapse yet, but these are the same early warning signs we've seen before previous housing corrections. Possible futures. So what happens next? Experts see three main scenarios. First, the most likely, a soft landing. Prices flatten, maybe dip a little, but the market avoids a full-blown crash. Second, regional crashes. Some cities could see 15 to 20% declines if local risks pile up, like job losses, investor sell-offs, or insurance crises. And third, the least likely, but still possible, a nationwide meltdown, like 2008. That would require a deep recession, mass foreclosures, and a credit crisis all at once. So what should you do now? If you're a buyer, lock in a fixed rate mortgage and make sure you can afford payments even if your income changes. If you're selling, price realistically. Bidding wars aren't guaranteed anymore. Investors need to watch job markets, rent trends, and insurance costs closely before buying. And renters should pay attention to local housing policies and insurance changes. They could affect future rent prices too. The big takeaway: a national collapse isn't guaranteed, but under the surface, risks are quietly stacking up. Some neighborhoods could face major price drops while the headlines stay calm. The question is, Will you see it coming before everyone else?